Hello and welcome to Bryant University. My name is Madan Anavarjula. I am the Dean of the College of Business here at Bryant University. It's indeed my pleasure to welcome you to today's panel, Fintech and the Future of Finance and Banking. This is the third of four panels in our fall series that were titled Paths to Recovery, Strategies for Getting Back to Work and to a Better Future. In this series, distinguished experts will focus on the road to recovery from the perspectives of healthcare, social issues, finance, economic competitiveness, etc. Each panel will examine how well we all can work together to shape a stronger future for all of us. We are grateful for the continued partnership of the Rhode Island Foundation, which partnered with us on the successful Pandemic Economics series this spring. We are also grateful for the sponsorship support of Citizens Bank and Fidelity Investments. You know, it's easy to think of fintech as very specialized and something that big bank executives and financial market gurus and Silicon Valley hotshots think about and profit from, and we all don't know or don't have any clue about. But the fact is, fintech and more generally technology is a big part of the lives of everyone here today. Technology is not only altering the landscape of banking and finance, it is changing the world of business, including accounting, marketing, and management. And to be successful in just about any area of business now and in the future, workers need to have an understanding of technology and a high degree of data literacy. At Bryant, we are constantly updating our curriculum to meet these emerging trends. We integrate data science and data analytics in almost all our programs, not only in finance, but across the College of Business. And recently we launched a data science major, and it has been very successful, and it's one of the fastest growing programs at Bryant University. Today's conversation, however, will focus on how the fintech industry has evolved to this moment, and where is it headed, and the impact that it has on the future of finance, banks, financial strategies, and outcomes for individuals and businesses. I certainly hope that you find today's panelists and the information that they share useful and insightful. And now, I want to introduce you to our moderator for today, who will get the program started in a couple of minutes. Some may recognize Margie O'Brien from Governor Raimondo's daily press briefings, where she assisted in getting out the news and information on the COVID crisis. Others know her as an award-winning journalist and an anchor who has been reporting the news for more than 25 years. Margie currently covers the Rhode Island legislature and political news as the host of Rhode Island Capital TV. She earned her bachelor's degree from St. Anselm College and her master's degree from Emerson College. She's a graduate of Leadership Rhode Island, and she sits on the board of the organization's Women's Network. Thank you, Margie, for being the moderator today. And now, let's get started.
Let's get started. Dean, thanks so much for that introduction. It's a beautiful day. This is an amazing topic, and we have so much information to share. So we really are going to begin. But first, I wanted to give everyone an outline of how it's going to go today. We're going to have a brief introduction of the panelists, and I am going to try to be mindful of the time. So I'm really butchering their wonderful resumes by highlighting what they're doing now, but I encourage you to check out their resumes online. And when you registered for this program, you got to see everything. Also, we're going to dive right into the conversation, but the whole time, if you have a question, right at the bottom of your screen, there's a little box for Q&A. That's where we would like you to put your questions. I know typically in Zoom calls, you're throwing everything in a Zoom, the chat room, but for today, please put your question in the Q&A, and then our group will go through it, and I'll be able to ask these questions of our panelists at the end of the program. So what we wanted to do first was to thank the students that are also jumping on. We know that there's so many of you that have chosen this today, and we're hoping that you will also ask some questions so we can make this relevant to your age group. When I was first asked to moderate this, I was really intrigued. I love the topic, but I have to be honest, I don't know much about this. So this is the extent of my fintech knowledge. I send $10 to my teenage son so he can get pizza with his buddies. He thinks it's great. I think it's easy. That's a win in my book. But I am so excited that we have this incredible group of panelists who can really elaborate on what fintech is. So let's start. With more than 20 years in working in financial services, Kate Bond is a leader and innovator in global finance. Kate has held executive positions at Deutsche Bank and Citigroup and is currently at Lloyds Banking Group, where she serves as incubator and accelerator lead. Mario Hernandez is the founder and CEO of M-Pesa, an innovator of electronic payment solutions, licensed with both Visa and MasterCard. And a shout out to Mr. Hernandez, he has earned his MBA from Bryant University. Nirbhay Kumar is the global head of fintech and market data sourcing at BNY Mellon. He served in various positions at Stratted, Alpha Point, and also FIS Global. He is an advisor to Bryant's Dean of the College of Business and is a connector and mentor to veterans entering the civilian workforce for the first time. Kumar is also an alum, earning his BA from Bryant University. It's great to have you guys both back here. And Bryant is fortunate to have Professor Peter Nigro as the Sarkeesian Chair in Financial Services at Bryant University. Prior to joining Bryant, Peter served as a senior financial economist in the Policy Analysis Division at the Office of the Comptroller of the Currency for over a decade. He is also the architect of this wonderful panel, so kudos to Peter. So just a little background. Fintech is all about innovation, disruption, and transformation, and will undoubtedly impact and shape the way financial institutions all over the world operate. In fact, a recent PwC survey states that over 80% of financial institutions believe that business is at risk to innovators. 56% have put disruption at the heart of their strategy, and 77% expect to increase fintech partnerships in the next 3 to 5 years. So let's begin. Kate Bond, I'm going to start with you. You are a superstar in tech, having spent over 20 years with a variety of stakeholders, clients, and agencies, dozens of startups and incubators. So give our audience an idea of what is fintech and who are these innovators? Who are you looking to partner for your next startup?
Thanks, Margie. Great to be a part of this lineup this evening. So conscious of time, so I'll get right into it. I think so broadly, fintech, financial technology, is any tech that's been applied to the financial services industry that seeks to either improve or automate or compete with the traditional financial services delivery mechanism, which is, the paper ledger and the branch network. Now we look at that today and, it's, as you mentioned, it's apps that pay for pizza with your son. It's Venmo, it's PayPal, that we're using our mobile devices to pay with for things on the go. And that seamless piece, nobody goes in and cashes a check or does that swiping of a credit card with 4 layers of bits of paper anymore. There is cryptocurrency, there's crowdfunding, there's cloud services, there's blockchain. It's a myriad of different things, all the way from sort of robo-advisors and budgeting apps to splitting a bill in a restaurant. And then you've got different divisions within that. You've got InsurTech, RegTech, Tech for Tech, which is kind of looking at the back end of systems and how we look at the infrastructure and architecture of financial services. And then when you come to the innovators, it used to be that it was all the cool young kids, and people talk about millennials all the time. And I have to point out to them, I think I'm Gen X, but the older millennials are all beginning to turn 40 now. They're not these bright young things that everybody thinks they're all 17, and so they are native digital users, but millennials are not the be all and end all. And oftentimes now, what they'll be, particularly in financial services, is those people who've been in a career already within an incumbent bank or even a sort of up and coming neobank, but what they've spotted is a challenge within their company or within their industry that just isn't being solved, but materially impacts either the customer or the internal audience on what they're trying to achieve and how they can simplify that piece. And they may have tried to do it as what's called an intrapreneur, where you are almost encouraged by your company. The company bears the risk, if you like, of you experimenting and seeing if there's a different way of doing things. But it could also be that actually the appetite of where you're employed just isn't there for trying to solve the problem or the niche area that you've identified. So often these times it's people in their 40s, 50s, 60s. They're looking to spin out, solve a problem. They're leveraging their network. They've got access to cash. And really some of the accelerators and incubators they get involved in are much more about sort of commercial modeling or financial modeling and the pieces that overlay the ability to deliver whatever they're thinking about and move towards that moonshot. And then from a pitching perspective, what do we look for? I personally, I'm less about the pitch, because people are learning to sort of create shiny content all the time, you know, vaporware, if you like. And I want to really understand what is the problem that they're solving? What was their eureka moment? You know, how do they want to solve things? The technology is almost secondary. And I like to say that that's why it comes second in the fintech phrasing. The financial piece is first and foremost. You know, don't be sitting there with an interesting idea, trying to punt it round to find a problem to attach it to. Make sure you know what your problem is. It could be that either, you know, it actually, when you come down to the bones of it, what you're actually punting is an add-on, a feature, if you like, that maybe would be surfaced through Bloomberg, for example, and it's not actually a whole business. I also like to know exactly what the strategy of those fintechs are, whether they are scale-ups or startups. Are they looking to sell? Are they looking to retain their privacy, their private status? You know, those kind of things, and the sort of more thematic pieces that align to the specific bank strategy in my day-to-day space.
All right, thank you so much, Kate. I do think it's interesting what you said about splitting the bill at the end of a meal. This has been a wonderful solution to not having that awkward moment.
As you whip out the data.
Exactly. Peter, I wanted to ask you, in the mid-1990s, Bill Gates predicted this. He said that traditional banks are going to go the way of the dinosaurs and will be bypassed by these tech firms. Do you think his predictions are coming true? Do we lose Peter?
Peter's on mute.
Oh.
I'm like my students now. Well, I think, sorry about that, Margie, thanks. So, I mean, the threat of bank extinction goes back a long way, yet they've managed to continue to adapt and transform themselves. I mean, just think in the 1970s, banks survived the emergence of money market mutual funds, which threatened their deposit franchise. In the 1980s, it was commercial paper was going to disrupt banking. In the 1990s, Walmart unsuccessfully applied for a bank charter. Congress denied him that charter. In fact, the Gramm-Leach-Blite Act was postdated to keep them out of banking because we want this separation between banking and commerce. In more recent years, technology, securitization, automated underwriting, credit scoring, combined with regulation have led to a smaller banking sector, at least in measure in terms of assets. So let me just elaborate on that for a second. We talk about credit scoring. We can quantify risk. And if we can quantify risk, we can take those previously illiquid assets, loans, and transform them into tradable securities. And that really has shifted banks' role in the financial markets from originate and hold to originate to distribute. And this change has been enabled by technology, securitization, as well as credit scoring, but it really has been driven in part by regulation. Basel III, Basel I, II, and III have made it more costly for banks to hold those loans on their balance sheet. So that the twin forces of regulation and technology have opened the door for the competitors that Kate was talking about to capture those traditional profit pools that banks have long controlled. So although banks have met these challenges in the past, I think this time is slightly different. The speed of change, the lack of borders, the size and scale of big tech, and fintech. They're very unique challenges. And when I think of banks' advantages in the past, I always tell my students the bread and butter of traditional banking is they take deposits and make loans. Well, their informational advantage in the data, which they've historically controlled, they don't anymore. It's the tech firms. The tech firms have more data. And to put this in perspective, when you look at the largest originators of loans out there in the consumer loan market, fintechs control the majority of the market, or the biggest share of the market. And even in the mortgage market, Quicken Mortgage is the largest mortgage originators. We have these fintechs taking over the traditional bread and butter of bank. So I think at a minimum, the emergence of technology in these fintechs will accelerate that consolidation in the banking industry, which we've seen over the last 30 years. When I came into the industry, started at the OCC, I won't date myself, but let's say the 1990s, there was roughly less than 15,000 banks. Today, there's less than 5,000. I think this trend will continue as some of the things that Kate mentioned, big data, AI, blockchain, become even more important. And I expect these banks, the banks that survive anyway, will morph to become more like tech firms, better able to manage and use their data, as well as making the banking experience more convenient and accessible to their customers. In fact, if you look at JP Morgan Chase or most of the larger banks today, they don't refer to themselves as banks. They refer to themselves as tech firms. And I guess I'm being too US centric here. I just want to mention that fintechs, the importance of fintechs in the developing world is much more important and transformative in nature than in the US. Fintech firms have made banking services available for the first time and have really have increased access dramatically. And just over the past 2 weeks, if you read the paper about Ant Financial will be the biggest bank in the world in the next 10 years. And they really started out as, as a subsidiary of Alibaba. And the initial goal was just to bring consumers and small businesses together so small business could sell their goods directly to consumers. And they solved this trust. They created an escrow account, and basically they kept the money in escrow until there was a delivery of the product and the customer was satisfied with the product. From these rather humble beginnings, Ant has grown to be at one point, the largest money market mutual fund in the world. They've created a bank, they've created a credit scoring system, and they've created a wealth management arm. They have transformed the financial system in China. I think that's true in a lot of developing countries where fintech has had a much greater impact than in the United States. So to sum up, I think, Margie, I think this time is different. Banks are becoming more like tech firms. And I think we're going to see ongoing consolidation in the US. We're going to see an increase in the concentration of assets amongst the big banks. And I think, as Kate mentioned, I think we're going to see more banks either to partner with more of these fintechs as the fintech world continues to grow.
And Peter, you mentioned regulation, and that's something I'm going to say for the next half of the program, because I think people are really interested in whether we're going to need more or less regulation for this. But I wanted to jump over to Nurbay. So you're hearing all about this competition, and as head of fintech for BNY, what types of fintechs are you most interested in to ensure that Bank of New York remains at the forefront of banking and finance? You have all this competition. How do you remain number one?
Sure. So I think, I agree with the point that Kate made, where I almost sort of shy away from this fintech moniker because it really is technology as a tool. Now, some of those technologies can be applied to multiple industries. And, when I talk to students, I tell them to kind of don't think of this as like a monolithic standalone industry. It has to be use case based. So at BNY, so we are different from other banks like a JP Morgan or a Citi because we are not actually a bank. It says the bank in our name. We are the oldest bank in the United States, founded by Alexander Hamilton. And we are regulated like a bank, but we don't function as a bank. We have no retail banking, meaning you and I can't go and open an account there. We have no investment banking. We have very little commercial banking, the way people think of commercial banking. So we are a custodian of assets. We are the largest custodian in the world. So a lot of our services, processes are quote unquote heavy. So historically, they've been very people intensive, very process intensive at a very, very large scale. We custody $37 trillion of assets, which is more than the GDP of a lot of countries. So the idea is that what we look for is similar to the point that Kate made. What problem are we trying to solve? Are we trying to make a process faster, more accurate, more efficient, or do away with a process that's not needed and can be done away with technology? So if you think of technology as a disintermediator, right? So coming back, Margie, to your $10 pizza payment, as opposed to going to an ATM, taking the money out, giving it to your son going to the pizza person and paying it, those are like 4 steps, and you've gotten rid of all of them. So the point is technology is a disintermediator, and it should be used to create efficiency. So, Peter mentioned in the 70s, 80s, it used to cost, hundreds of dollars to do a stock trade, right? So Merrill Lynch was the name then, right? I don't know if anybody calls them that anymore, but it used to cost hundreds of dollars to do a stock trade. There was a small minority of people in the country who could afford to buy and sell stocks. Everybody does it now. It's free practically to do a stock, and you can do it on your phone with the Fidelity app or Charles Schwab app or whatever. So we look for technologies that can improve the client experience, the end client experience. That's one. That's like a baseline thing. So it's a use case. We go look for the companies that can help us solve for that. The second piece is technologies that can help us launch new services and products. So which would have been impossible to do because they might be too people intensive, too expensive, take too much time to launch. So time to market is another thing that technology helps us with. And then the third piece is that in terms of looking at companies that we can partner with, we are heavily, heavily, heavily regulated. So for us to go and get a vendor, a startup company to work with us, there is a process which most startups are going to like shy away from because all banks are very heavily regulated. So we need to find partners who have the capability, bandwidth to come work with us. We can help them along that process. But again, it keeps coming back to, can they scale? Do they understand our underlying business problem? So we are not actually, the technology piece is great, but if they don't understand our underlying business problem, they're not going to be able to solve for it. So the same point that some of the folks have made, a lot of people are not the people we are dealing with in these fintechs are not young kids out of Stanford and MIT. They are seasoned professionals who've had 15, 20, 30, like 25 years in capital markets, banking, asset management, who have basically said, okay, we want to start our own company, be part of a smaller, more faster growing company. They understand the business problem. So when they pitch to us, it's like talking to somebody you work with because they're like, oh yeah, completely get it. Here's how our technology can solve for that. So I think it's very important to understand the business process and then figure out where technology can be a disintermediator. And I use the word disintermediator very broadly, but essentially something that takes away friction.
Right. Well, I think that one of the things that we can all agree on is that one of the areas that fintech has really taken hold of is the payment side of things. And as a former banker, Mario Hernandez, you are at the forefront of this now as the founder and CEO of M-Pesa. So I'm wondering if you could tell us a little bit about your company and if, as Nirbe said, your timing was right to start this. Where is your company? What's your goal? What's your growth been like? Oh, Mario, you're muted.
Sorry about that. Thank you so much for having me here. I'm really happy about what Nirbai and Kate mentioned because I'm one of those former bankers. I was a CEO of a regional bank here in Costa Rica. I retired, well, not retired. I started my fintech company when I was about 6 years ago. And basically, the reason why I decided to start my company, and back in 2013, when I started knocking on doors to raise funds for my company, people didn't even know what fintech was. I didn't even know that I was founding a fintech company. It wasn't until 2017 that we decided to raise our Series A that our investor said, okay, you have a fintech company. So I think that from my experience, one of the reasons why payments have grown so much is because it's part of the day-to-day thing that keeps you attached to a bank. So banks are much more than just payments. Banks, like the bank I was running, we had commercial banking, we had mortgage, car loans, we had a whole bunch FX, wire transfers. There's a whole wide of products that banks are, or products that banks have, but payments, not only I think it's the most profitable, but it's also the one that allows you to grow faster and the one where people have the most needs. You don't have a lot of needs for your mortgage. You just go to the bank and pay once a month. But if someone provides you as Nearby said, says to you, now you only have to press this button and you will be able to send your son $10 for his pizza instead of having to go to the ATM and doing all that, then there is a big need. I would say customer experience is one of the most important things there are, and that's one of the biggest reasons why fintech companies are growing so fast and being started so with such a success. I think that my business model when I started my company was B2B, meaning I provided technology to the banks, and I completely relate with what Nearby said, because there are a couple of banks. We work with over 30 banks in about 6 countries now, and there's banks that it's taken me 3 years to implement. 1 year ago, I did an alliance with PayPal, and from the first meeting that we had until the go-to-market, we went through the signing process of the contract, due diligence of my company, developing the coding the solution. It took us 8 months, and it's our fastest growing product, and it's our #1 revenue generator in my company. Whereas, we've had products for 4 or 5 years, and their growth is just much slower because the banks, it takes them so much because they're so heavily regulated, and it takes them so much to even make a decision.
Mario, let me ask you before you go though. I know that banks are trying to make it easier for the consumer. You don't have to go in anymore and see the teller. You go to a drive-up ATM, pretty simple. But because everything else, this technology is that much more simpler, the Venmo, the Apple Pay, will banks be able to compete with this?
That's a great question. So behind this button that you just showed us, there is a lot going on that not necessarily bankers know. This button that you press to send $10 to your son, behind it is there's telecommunications, there's payments, there's working with mobile companies. There's a lot of things going behind all that bankers, maybe they don't know, most of them. I mean, I've talked to lots of bankers that are not familiar with blockchain. They don't know what blockchain is and how it can help them, let alone cryptocurrencies. Just how can blockchain help them? So my my personal opinion is that banks will probably have a much harder time because they are not experts in customer experience. So you have Apple Pay, for example. Last time I saw, they had, I think, about $300 billion in cash. And they decided not to put their cash into their Apple Pay. They could have started at their own bank. Instead, they decided, I believe it was Goldman Sachs who was underwriting their loans for the Apple Card, and Goldman Sachs bears the risk, does the credit analysis. They put those loans on their books, but Apple Pay provides what's most important, and it is the customer experience. So Venmo, I would say it's about the same. I mean, what they provide and what's very, very important, and that's the reason why my company has been so successful working with banks, is because we go to them and we tell them, listen, this is your credit card, and there's no features on your credit card. We can provide this to you with our mobile app. We can provide you with technology that will make you more competitive. So, you know, we help smaller banks. I would say that probably the JP Morgans and the Bank of Americas and all the bigger banks, they already have they have lots of money to put into creating these tools. But there's 7,000 banks, I think more than 7,000 banks in the US. So the smaller banks are really struggling because they need to find that technology. And that's where we come in.
All right, what a great first half hour. Lots of information shared. We're going to go into another round of questions. The answers are a little bit shorter this time because we do want to save time for questions at the end of the program. And already we are getting some really great ones, especially from the students. So if you do have something that you want to ask, you can just put it in the Q&A box, and we're going to get to that at the end. Kate, let me go back to you for a second. We've heard a lot about the importance of fintech and disruption. But right now, we are still in this middle of this pandemic. And even despite the great news from Pfizer yesterday morning that they have a 90% effective rate for a vaccine, there's really no end in sight. So how are you counseling your clients on this and helping them not to just survive, but thrive during this time?
So there are a number of things that the bank specifically is doing it's from a UK perspective, so I apologize if I'm using references and terms that aren't quite so familiar to people, but on a broader basis, from a retail bank perspective, so that sort of B2C business to customer model of the man in the street, the lady in the street, you know, we're doing payment holidays on mortgages, on credit cards, on loans, on motor finances. Because again, back to Mario's point, it's not just the retail bank, and also with Nurbe, you know, there are all these different umbrella pieces that Lloyds Banking Group makes up. You know, we've got emergency access to fixed terms loans, we've got base rate reductions, we've got you know, contactless payment limits have changed from a £30 original maximum up to 45, and I know that in Apple Pay it's like £1,000, and I'm sure it's something different again in the US. But you know, interest-free overdrafts. There's any number of things, and then sort of on a more sort of business-to-business perspective, we've got big conversations, capital letters, happening in the northeast of England, where we're bringing people who would be our small to medium enterprise customers. So that would be, you know, private entities of either news agents or smaller businesses, and having really big conversations about what the difference is around the sort of digital divide between that sort of northeast of the country or around the cities compared to the more rural areas, and really trying to understand what some of those challenges are for them. But then we also have a Lloyds Bank Academy where we're trying to look at how we digitally upskill the general populace, because as Mario, Nebe and Peter have all referenced, you know, the roles and the way in which we integrate with the world is changing so rapidly. We need to make sure that people can even begin to have a conversation in that space. You know, if we apply for a job these days, we don't generally do it by snail mail. We don't send our resume in the post. we'll do it electronically, we'll apply online. But actually, if you're not familiar with how that works, you know, it's not quite, you know, did you plug it in, did you turn it on? But there's certainly an element of, are you comfortable with how to fill in on an online application and those kind of processes? So there's lots of things from a very practical perspective, all the way through to sort of the more sort of policy driving discussions that are happening.
So one of the points I wanted to make is that COVID has been fantastic for fintech, just so you know, because it's forced previously unwilling entities who were either too slow or didn't want to take on the effort or the cost to do certain kinds of digitization. It's forced them to do it. There's no choice now because, and I'll give you an example. So everybody has a brokerage account, and from time to time, you'll get once a year, you'll get a mailing, like an actual thing in your mail, which is like proxy voting, right? So you own stock in Blackstone, you'll say, okay, this is your form, fill it out, send it back. Most custodians are doing that through snail mail. And it costs millions and millions of dollars a year across the globe to do that. And there's no rational reason to do it anymore because people have email. And there are other ways to have guaranteed delivery. So our clients used to be like, oh, we don't want to sort of, you know, go down the path. We have to make some investment in technology. Now there's no option because the mail's not that reliable or there are delays and people are not checking because, so it's forced the digitization of certain processes that were antiquated across the board, not just, you know, BNY, but across the board. So it's actually, there's a funny chart, and it was a little tongue-in-cheek as to, you know, what are the 4 reasons for the expansion of digitization. And like, it was COVID, it was new technology, it was like 4 things, and it was like COVID, check, because, you know, that's what's forced, because we have no choice. People aren't comfortable giving banknotes. It's forcing digitization, it's forcing electronic payments. People aren't going out. So what do you do?
So let me just throw this out, and really anyone can jump on. Who's pushing back? Is it a generational thing? Older people are like, look, I like my little checkbook. Dottie, the teller at the bank, is my friend. I'm not going to change. Are you just trying to appeal to a younger audience because you know you're going to have them someday?
I would go with the answer of absolutely not. So one of the biggest things is very much around accessibility. So how do we make sure that we retain customers across the board? How do we ensure that they are financially literate? How do we make sure that they feel that they're in control of what they need to be in control of, and really understand and have them participate in the conversation and not just sit there sort of nodding when some specialist tells them how they should manage their affairs and maybe isn't really understanding what their personal needs are. So absolutely not just appealing to the younger demographic. And also, you know, there are older people who are incredibly digi savvy, and then there are younger people who, you know, my brother works in tech. The last thing he's going to do is have any kind of tech profile about anything because he's completely paranoid about what you might see. So there's those huge discrepancies around how people envisage different demographics, which I think, again, a bit like millennials, people hang on to it a little too much. So, you know, we do have mobile branches, you know, literally like vans that go around enabling those people who do want to speak to the same teller on a daily basis and are creating those sort of senses of community, but at the same time making sure that we are enabling people to engage with us in whatever channel, whichever method is their preference, whether it's telephony, whether it's online, whether it's in person. And then there's also the accessibility pieces around people with either learning disabilities or, you know, hard of hearing, deaf, blind, etc., etc. There are all of those things that we are trying to bring to it. And then you sort of take on the hyper-personalization around, you know, what's your personality style? You know, do you have a large risk appetite? Are you gregarious? Are you an introvert? All of those kind of things are beginning to taken into consideration.
All right. This next question has come up in 3 different topics, all about regulation. And one of our audience members, Jordan Hoey, asks, do we need more eyes? Do we need greater regulation on this business? Oh, Peter.
Oh, let me, all right.
Go ahead, Mario.
So let me give it a shot. I'm the chairman of the Central American Fintech Association, and I was recently invited to deliver a speech in front of all the regulators. And there's a Central America, South America group that meet once a year. And I thought that I was invited because they were going to throw tomatoes or something to me. It was very interesting conversation. They wanted to know if fintech was to be regulated. And so I guess I'm being a banker, I'm pro-regulation, provided three things. First, you have to regulate compliance, which is very important. Banks have invested tons and tons of millions of money, making sure that those people that we don't want stay out of the banking system. Second, financial intermediation. That's why banks, that's what regulators do. If you're a fintech and you're doing financial intermediation, taking loans and taking deposit and lending money, you're not a fintech company, you're a bank, and you should be regulated. And third, and probably most important thing that should be regulated is security. Because again, banks have invested millions of money in security. Today, more than ever, I agree with Nearby, COVID has come to, it's the biggest promoter of digitalization, but also there's lots of fraud that are occurring right now. So fintech companies, if something wants to be regulated, are those three things. And the last thing that I mentioned is that you have to put in a balance regulation and innovation. You cannot limit innovation because of excess of regulation. So, I think that there should be a balance between regulation and innovation. But yeah, I think that there are some things that should be definitely regulated.
And Mario, I'll add two things to that. From a consumer's perspective, I think, at least in the United States, anyway, I know this is not true in the US, data privacy is a big thing. And that's something we're woefully behind the world in. And as I tell my students, if the product is free, you are the product. They're using and selling your data. Customers have to have the right to determine who can access their data and decide how and where it can be used. And the last other area of regulation I think is really important, that is financial stability. I mean, if one of these large tech firms gets into banking, I mean, if that large tech firm failed, it could possibly bring down the whole financial system. I mean, just think about Ant Financial. So people have to remember that fintech firms, because of their business model, are much more vulnerable to adverse economic shocks because they don't hold as much capital. So although bankers complain about being forced to hold so much capital, if they didn't, this COVID crisis could have turned into a banking crisis. So I think that's really important. And the U.S. regulatory system is so screwed up in that a lot of these fintechs, to operate in the states, we don't have a national fintech charter. So they have to go to each of the individual states and get approved, which makes it incredibly costly and time consuming. So from both the consumer level, the fintech level, and more a macro prudential perspective, I do think we need more regulation. But to Mario's point, we have to balance that with innovation and acceptance of these disruptive technologies.
Mm-hmm.
And Margie, can I add to that a little? Do we have time?
Sure, a couple of minutes, go ahead.
Cool. So I was equally going to say, I mean, yes, you're right. COVID has definitely accelerated it, but then Mario and Peter are also correct in as much that, we do have risk and regulation. And on one hand, you've got the 2008 crisis where somebody says, oh, but you didn't say I couldn't. And we're getting a lot more about simplification of rules and thematic kind of guidelines coming in that ask you to act on the sort of the spirit of the commentary rather than just the absolute letter of the law, if you like. So I think we're probably getting slightly less draconian type direction coming down to us on the understanding that actually we don't want to sort of prescript what the answer is or is not, because it's a bit like, you didn't tell me I couldn't wear the gold lame hot pants to work, in the big list of what, 75 pages of what I could and could not do. But now it's become like General Motors, dress for your day or dress appropriately. It's become much more interpretive, but that means that actually we are made to think and be more constrained about what we're doing. And then on the other side, in terms of, again, risk for the bank, risk for the customer, we are beginning to work in a very different way when we engage with these fintechs and the startups and scale-ups. The activities that we're doing them are no longer those big tech strategic 5-10 year partnerships. And our onboarding KYB, KYC is not necessarily fit for purpose for those different interactions. We don't have a common lexicon in terms of what is a proof of concept, what is a proof of value, what is a pilot. I could be talking about a pilot, and you're talking about a proof of concept, but we're talking about the same thing. So there's risk appetites and risk models for what are we doing, what does it involve, how long is it going to take, what sort of data do I need? These are all really amorphous things that haven't yet quite been tied down. And I think coming to that point of being regulated, we do move much more slowly as the incumbent banks and deeply aware of that risk. Whereas neobanks, they've got less, they usually only have customers who are using them as a secondary bank account, not a primary bank account. They have a greater appetite for risk because they've got less infrastructure that's sort of creaking around the edges. And although they're getting there. And that whole piece of sort of moving the tanker and trying to get people to get their heads around different ways of interacting and how we do more partnering and less kind of that conservative, they're coming to disrupt our market. Actually, we're all working on the same side. We're all just trying to make it a safe and seamless experience for the customer, where we have all these sort of joined up bits in the background that does have infrastructure and architecture that allows real-time notifications and all those things that everyone's beginning to come to expect now.
Oh, Kate, I think that you raise a lot of points, and Peter, this could be the framework for another whole virtual event, and I'm happy to moderate. But I did want to break into another whole topic, and that is, where are the jobs in the future? I mean, obviously technology is transforming financial services. Do colleges have to change their curriculum? Do people now looking for jobs have to find an extra skill just to put their resume out there?
Yeah, so I don't think it's a question of an extra skill. I think it is a recalibration of skills. So Peter and I and Madan and others from Bryant have spent the summer several times talking about, this concept of core curriculum, right? So most colleges in the US have this 2-year and a half core curriculum where everybody's doing a similar baseline set of courses. And that is the piece that I think needs to be recalibrated, because it's probably not been revisited since the 70s, maybe even before that. So, it's the exposure to things like data science, which impact all industries. And data science is a fancy new name for, combination of statistics and sort of analysis and things like that. But the idea is that it's applicable to every field. It's applicable to every industry. So at least exposing students as part of the core curriculum, something like that, and say, okay, here are case studies in television, here's a case study in healthcare, here's a case study in financial tech. At least give them a flavor of what it means in reality as a case study way. And then for those who want to build on it, can build on it and, major in it, like Bryant has a data science major. I work with students, freshmen through senior year students at Bryant, at NYU. And the one thing I tell them is, I say, if you're a freshman, doesn't matter what you major in, go learn a coding language over the next 4 years. And they're like, coding. I'm like, think about it. It's easier than learning a natural language because you don't have to speak it, right? So it's only half that effort because you don't have to learn diction. So the idea is that if you get exposure, understanding, you don't have to become an expert programmer, but at least if you can understand sort of what's going on behind the scenes for everything, your iPhone, your video games, your anything, your Hulu TV, your Apple TV, anything you use. If you start understanding what's going on behind the scenes and appreciating that, I think when you get into any job, any kind of job you might have, one, it helps you get into the job because you can talk with some intelligence about it. And then secondly, when you do get into a job, and I mentor veterans and students who are, and folks who are actually in their careers, and I say, think about the problems you're having day to day. What's taking you time to do? What's taking too many people to do? What's causing a lot of mistakes? What's not efficient? Those are the things where you can, if you have a little bit of this other background on data science, on programming, you can say, okay, you know what, there is a way to solve these problems once and for all, or solve them for everybody in my organization, as opposed to just, you know, me trying to do the same process again and again, and it's taking me 5 hours a week more than it should. So those are the kind of skill sets. So it's a flexible mind and the ability to understand sort of these moving pieces. Nothing is in isolation, like everything is connected. And the sooner you start seeing those connections, the better off you're going to be.
Peter, did you want to add to that?
I hope all the students are listening. And I think we are headed in that direction. We've made a lot of changes at Bryant, but I think there's a lot more work to be done. And one of the things that's great things about Bryant is we really do prepare our students for the real world. So I know all our students online are taking it to heart. So I agree 100% with Nirbhay.
All right, as I said, we have some great questions and I'd love to get into them. Here's one from Ben Koplovsky. What is stopping the United States from starting a cryptocurrency? Should a government entity produce an e-currency?
So can I speak to the second piece? Because I don't want to get into whether the US should or should not, but I think there's been a lot of discussion in Europe and the UK about cryptocurrencies and, you know, who owns what. And we talk about sort of the cloud and it's open to everybody, but actually it's owned by about 3 big corporate private entities. So it's not public at all. And therefore, I think cryptocurrencies are in danger of heading down the same line. So it's almost kind of, if you could have an EU currency that was, or a government-based backed currency, cryptocurrency, then we ensure that it doesn't end up being owned by single institutions with potentially some not nefarious kind of bias to it, but certainly a personal agenda rather than a public agenda.
Mm-hmm.
So I have a view on this. I worked at a crypto startup for 14 months mid-career, which was an interesting experience. So it's not, so currency, especially if you look at fiat, right? If you're talking about government issued currency, it's fiat. So it can't exist in isolation and be digital because economic policy, financial policy, the levers of those policies, interest rates is all driven off that. So there has to be a semblance of control, not just ease of use or ease of transfer. Like those can't be the underlying logic. So there has to be a framework that has to be well thought out of, you know, looking at data for the last 100, 200 years, or since the Bank of England created fiat or whenever, and sort of really kind of understand what that framework is, what the corner cases are. You have to account for all kinds of scenarios. That needs to be thought out first before actually issuing or moving to a digital currency. Like technically is not that hard. I personally think that smaller countries in third world, fourth world markets are probably much more likely to get to a national cryptocurrency first, as opposed to an established global currency like the pound or the dollar or something like that. I think it's much easier for some of, Congo, Republic of Congo, or even the African Union may be coming up with a unified currency. But I don't see the US dollar or the pound or the yen, going that way without this underlying framework being built, which is going to take some time because it's going to regulation and legal and, buy-in from global central banks and so on and so forth.
All right, I think that there's a majority of women who have been sharing a meme since Saturday night when Vice President-elect Harris gave that amazing speech of a shattered glass ceiling. It gives us hope that things are going to change for women, but we can't rely on hope. So how do we get more women into this field? And Kate, I definitely want your opinion, seeing that you're a finalist for the 2020 Women in Tech Leadership Award. But gentlemen, weigh in. How do we get more women to major in the business in college and also want to go into this field and feel heard?
So yeah, please do, chaps, weigh in. I think we all recognize that it's not necessarily a female thing. It's definitely a human thing. Most of the senior positions that hold sway in how people get promoted, seen, sponsored, are gentlemen. And so we are absolutely reliant on those people at the top of the tree to want to see change and reflect boards and senior executive committees that look like the rest of the environment does. Margie, you made a point at the beginning where you said that those companies that have mixed or female boards do better and are more successful. I came into banking after 10 years in the art world, so probably beginner's luck had a massive part to play in it. I had no expectation of how things should be done or how things had always been done or any of that. So I just kind of looked at things and went, that doesn't really work. I think sponsorship is hugely important. Those structural things, the fact that we're even asking the question means that we're definitely moving forward. When I came into banking when I was 29, and it was still, there were no ladies' bathrooms on the top 2 floors because that's where the management meetings were. So why would you have ladies' bathrooms on those floors? At best they were coming in, bringing the tea and scuttling out very rapidly. So I think that's definitely hopeful. And from a personal perspective, I've conscious that the primary care of all things from I joke about from grandparents to dependents to goldfish seem to come down to the tenant of the female taking on that sort of primary carer role. And I think it behoves all of us ladies to sort of make sure that we shine a spotlight and we create opportunities for other women and other talent around us to sort of really shine that spotlight. And there's a hashtag that goes around, hashtag lift as you rise. If as we've seen with the speeches over the weekend, you may be the first, but it behoves you to make sure that you're absolutely not the last. We don't really want token women or diverse ethnicity backgrounds or heritages sort of helicoptered in just to tick that box. We need to make sure that the pipeline is growing, and if there's a gap for how we move people into those different roles, those different areas, whether it's spot trading or exco positions, are we making sure that if that person wasn't the best person for the role today, have we then supported them to make sure that the next time they're in that opportunity, they are the best person for that space and they're being supported to bridge that gap?
So there's some specific things, also we can do. I think if we sort of take it back to, let's say, middle school, grammar school, elementary school, I think demystifying technology or introducing kids overall to technology that early on. And I think the next generation has, I think, a lot less of these ingrained, whether biases, baggage, whatever you might want to call it, than we do, and a lot less than maybe generations older to us do. But I think introducing these concepts early on, so there are lots of these women who code, lots of big companies have these, but I almost think that it should be done in high school or middle school, where there is a trajectory. You can show a career path, you can show area of interest. So, making it sort of easy to access technology and technical knowledge, or knowledge about technology, I think that will kind of perpetuate itself. BNY is probably a little unusual. Our CFO, our CTO, and our COO are all women. And they've come to us mostly through within banking, but through various paths. But so our head of HR is a woman. It's like, aside from probably our CEO and a couple of other people, I think most of our executives in very, very senior roles are women. But we are doing a lot. I think one of the things I saw, and I don't know if this would work or not, but is we've removed, or whether it was us or some other bank, I was on some discussion where they've gotten rid of, when somebody applies for a job, they've gotten rid of this concept of like your gender. Mm-hmm. So it wasn't us, it was somebody else I was hearing, but there's sort of some of that happening, and it addresses not just, to sort of manage the imbalance, but also with a lot of other things happening in society, right? Diversity, inclusion, equality, to balance those kind of things out, where they're actually suppressing the name of the person in the application. So you look at their qualifications, you look at the experience, you don't try to sort of identify sort of what like ethnicity they are, or what gender they are, or whatever it is. So you call the applicant in for an interview based purely on their qualifications and experience, as opposed to saying, oh, this person might be from this area, or might be Latino or African American, and trying to do that kind of stuff.
Although the slightly scary thing, Nobe, you mentioned when you're reading the surveys, the CVs, the resumes, you don't have their names, and therefore you can't tell what their gender is or their ethnicity. The really scary thing is when we've got those sort of AI systems that do that pre-scanning for us, the bias is built in. The bias Yep. can tell, given that they did this course at this university, we can tell that that's a female. Given that they speak Urdu, given that they speak, whatever the different languages are that are then reflected as mother tongue, we know where they come from, what their ethnicity is. And so those biases can still pre-filter before you even get to see it, and you don't know what their name is.
Yep.
You end up, and unknowingly, you've already got 15 white men, or 25 white females who all went to a red brick university and studied economics. So I think there are those pieces that we can get really clever about how we try to filter it down, but at the same time we have to be really aware of being a little too clever for our own good sometimes.
All right, I wanted to ask a couple quick questions right now, and this could be rapid fire round. Julie Shaw says, will cash payments be a thing of the past in the future? And you can tie your answer in with Andrew McKenzie's question is, what's the greatest risk of this fintech? Is it the hacking?
So at the risk of monopolizing, I think the biggest risk, so I'll skip the first one, but the biggest risk is actually operational resilience. The more that we continue to partner, and rightly so, there's an operational resilience perspective. If a company goes bang, a small entity that we've been relying on to deliver something to our customers, and for whatever reason they go bang, it's all well and good having that code in escrow, but if we don't have the skill set of how we leverage it, how we use it, how we implement it, we're scuppered. And we may all be using microservices, but let's hope you've got your backup plan to quickly slot somebody in and keep going. So I think that piece is huge. And also the security aspect. Yes, of course, you don't want to have everyone's private data in the public space. And that's almost, Mario, I would default more important than the customer experience. The customer would rather have a slightly clunky experience and know that they are 150% safe than they would have a seamless experience and be slightly nervous about their data ending up in the public forum.
Yeah, and there's been a huge shift in the payments over the last 30 years. I mean, checks used to be the most important. I do think cash will eventually be phased out once we deal with those cyber risk and hacking, but there's no, like Margie said earlier, I Venmo now. It's just so much easier than giving my kids $20 to go to Chick-fil-A every week. Just Venmo them $10 and I'm done. So cash is definitely on its way out, in my view.
It's interesting. We actually had a piece of legislation come before the House that wanted companies, small businesses, to still honor cash because people felt that they were being discriminated against because they only had the charge card. I have to say, this was amazing. And I really think that we have so much more information that we could really do another one. But I wanted to thank our incredible panel, starting from Dean Anavarjula, also our panelists, Kate Bond, Mario Hernandez, Nirbe Kumar, and Peter Nigro. Thank you so much. We also really wanted to give a shout out to our sponsors, Citizens Bank, and of course, Bryant's nearby neighbor Fidelity, just down the street. This was the third of the 4 series. We do have one more to go, and that is titled The Challenges Ahead After Historic Election, which you know is going to be a great discussion. So pull out your phones now, mark it down on your calendars. It's December 9th, starting at 10 o'clock. I am going to be thrilled to moderate one more time. And I'll be joined by Bryant President and also Philip Thompson, who is the Deputy Mayor for Strategic Policy Initiatives in New York City, as well as Mark Zandi, the Chief Economist at Moody's Analytics. So you can check out all the information and you can register for this next one, The Challenges Ahead After a Historic Election, by going on to news.bryant.edu. To everyone that has joined us, thank you so much for this incredible afternoon. We wish you well and be safe.